The IRS has just released its annual inflation adjustments for the 2025 and 2026 tax years, affecting over 60 tax provisions. These changes, driven by inflation, are designed to prevent bracket creep, so your tax bill doesn't rise just because your salary keeps up with the cost of living. This year's updates are especially significant due to the new One Big Beautiful Bill Act, OBBBA, which makes several tax provisions permanent and introduces new ones. Nearly every taxpayer will feel the effects, from higher deductions to expanded credits. In this guide, we'll break down the most important changes so you can plan ahead and maximize your tax benefits. The standard deduction is the easiest way for most Americans to reduce taxable income, and it's going up again. For 2025, single filers can deduct $15,150, married couples $31,500, and heads of household $23,625. In 2026, those numbers rise to $16,100 for singles, $30,200 for married couples, and $24,150 for heads of household. These increases mean you can shield more income from taxes without itemizing. For a married couple, that's over $32,000 tax-free before any other deductions or credits. The higher standard deduction simplifies filing and offers immediate relief from inflation. Most taxpayers will see a lower tax bill and a simpler process. This automatic adjustment helps ensure your paycheck goes further, even as costs rise. The IRS has widened all 7 tax brackets for 2026, making significant adjustments to account for inflation and economic changes. This move is designed to protect your income from being pushed into higher rates by inflation, ensuring that your purchasing power remains stable. For single filers, the 10% rate now covers the first $12,400 of taxable income, while the 12% rate applies to income up to $50,400. The 22% rate kicks in for income between $50,401 and $130,000, and so on, with the top 37% rate starting at $600. These adjustments mean that more of your income is taxed at lower rates, reducing your overall tax burden. Married couples filing jointly see the 10% rate up to $24,800, the 12% rate up to $108,000, and the 22% rate up to $260,000, with the top rate of 37% starting at $768,700. This means that couples can earn more before hitting the highest tax rates, allowing for better financial planning. It's important to remember that only the income within each bracket is taxed at that rate, not your entire income. This progressive system ensures fairness. For example, if you earn $52,000 as a single filer, only $1,600 is taxed at 22%. The rest is taxed at lower rates. This tiered approach helps manage your tax liability effectively. Without these adjustments, more of your income would be taxed at higher rates, significantly increasing your tax bill and reducing your disposable income. These changes quietly protect your purchasing power, allowing you to maintain your standard of living despite economic fluctuations. The result is more take-home pay and less tax stress, giving you greater financial freedom and peace of mind. Families will benefit from a permanently expanded child tax credit, now indexed to inflation. For 2026, the credit rises to $2,200 per child under 17. The refundable portion increases to $1,700 per child, so even families with little or no tax liability can receive a refund. This stability allows parents to plan ahead, knowing this support won't disappear. For example, a couple with 2 children could receive up to $4,400 in credits, and if their tax bill is low, most of it could come as a refund. The expanded inflation-adjusted credit is a powerful tool for reducing child poverty and supporting working families. With these changes now permanent, families can budget with confidence. The child tax credit is now a reliable source of annual support. The Earned Income Tax Credit, or EITC, continues to serve as a vital financial lifeline for millions of low and moderate income workers across the country. Designed to reward work and reduce poverty, the EITC helps families and individuals keep more of what they earn, making a real difference in their daily lives. For the 2026 tax year, the EITC is getting a significant boost, increasing the amount of support available to those who need it most. The maximum credits are set at $664 for workers without children, $4,127 for those with 1 child, and $7,116 for families with 2 children. For families with 3 or more children, the maximum credit rises to $8,231, providing even greater assistance to larger households. One of the most important features of the EITC is that it's fully refundable. This means that if your EITC amount is more than the taxes you owe, you'll receive the difference as a refund, putting extra money directly into your pocket. For many working families, this refund can help cover essential expenses like rent, groceries, or childcare. For example, if you owe $500 in federal income taxes but qualify for a $4,000 EITC, you'll receive a $3,500 refund from the IRS. This extra cash can be a game changer, helping families get ahead or manage unexpected costs. Each year, the EITC is adjusted for inflation, ensuring that the credit keeps pace with rising living costs and continues to provide meaningful support. Despite its benefits, millions of eligible taxpayers miss out on the EITC every year, often because they don't realize they qualify or don't file a tax return. Be sure to check your eligibility and file your taxes, so you don't leave this valuable money on the table. For working families, the EITC acts as a direct cash infusion, helping to build financial security and stability. It's widely recognized as one of the most effective anti-poverty tools in the entire tax code, lifting millions out of poverty each year and strengthening communities nationwide. In 2026, seniors across the country will see some of the most significant tax relief in decades, thanks to sweeping changes designed to ease the financial burden on older Americans. These new provisions are aimed at helping retirees and those nearing retirement keep more of their hard-earned money, providing a real boost to their financial well-being. One of the biggest changes is the increase in the additional standard deduction for those aged 65 and older. For single seniors, this deduction rises to $2,050, while married couples filing jointly will see an extra $1,650 per spouse. This means that married couples where both spouses are over 65 can claim a total of $3,300 in additional deductions, making a noticeable difference when it comes time to file taxes. But the real game changer is the new senior deduction, introduced by the OBBB. This deduction adds a substantial $6,000 per qualifying taxpayer over 65, offering even more relief to those who need it most. However, it's important to note that this deduction begins to phase out for higher-income seniors, ensuring that the greatest benefits go to those with more modest means. For a married couple where both partners qualify, that's up to $12,000 in extra deductions, in addition to the standard and additional deductions already available. When you add it all up, these layers of deductions can dramatically reduce taxable income for seniors, making it easier to manage expenses in retirement. For example, a couple where both spouses are over 65 could potentially deduct as much as $47,500 before owing any federal income tax, providing a significant cushion for those living on fixed incomes. The senior deduction begins to phase out above $75,000 in adjusted gross income for singles and $150,000 for couples, targeting relief to those who need it most and ensuring the program remains sustainable. This thoughtful approach helps direct financial relief to lower and middle-income seniors, rather than those with substantial retirement savings. These changes are designed to help seniors keep more of their retirement income, reduce financial stress, and enjoy greater peace of mind as they age. The end result is lower tax bills and greater financial security for millions of older Americans, allowing them to focus on what matters most in their golden years. For many senior households, this multi-layered relief could even eliminate their federal tax liability entirely, making retirement a little bit easier and a lot more secure. Estate and gift tax rules are now more predictable, thanks to ABBA. The federal estate tax exemption is permanently set at $15 million per person, indexed to inflation. Married couples can shield up to $30 million from federal estate taxes. The annual gift exclusion remains at $19,000 per person, allowing tax-free gifts to as many people as you wish. These provisions make it easier to transfer wealth and plan for the future. Family businesses and farms can now be passed down without fear of a sudden tax hit. The new rules provide stability for long-term legacy planning. The OBBBA made several major tax changes permanent. The personal exemption is gone for good, replaced by a larger standard deduction. The SALT deduction cap jumps to $40,000, offering relief to those in high-tax states. The Qualified Business Income Deduction, Section 199A, is now permanent, letting small business owners deduct up to 20% of their income. The alternative minimum tax, AMT exemption, is set at $90,100 for singles and $140,200 for joint filers. But the phase-out starts at lower incomes, $500,000 for singles, $1 million for couples. These changes provide certainty for families, business owners, and high earners. The new rules simplify planning and reduce tax surprises. OBBBA's permanence means fewer last-minute tax law changes. The 2025 and 2026 tax changes offer targeted relief and greater stability for most Americans. Higher standard deductions and wider brackets mean more take-home pay and less tax stress. Families benefit from a larger permanent child tax credit and a stronger EITC. Seniors enjoy new substantial deductions that can eliminate their tax bill. Business owners and estate planners gain certainty with permanent rules. While some high earners may face new AMT limits, most taxpayers will see positive changes. Start planning now to take full advantage of these updates. Being proactive ensures you keep more of your hard-earned money.